Welcome to the tax savings haven that is the state of Florida. Thanks to the Wall Street Journal and the folks at BDO, which is a big accounting firm, we're able to quantify what that tax savings is. So we'll talk about that on the program, along with the fact, have you been pitched on what has become the latest hot product in the insurance industry? Be careful. It's just a retread of what you might have seen 30 odd years ago. So we'll talk about that as well on the program. Plus, delve a little bit into the fine print that is in the Secure Act. The Secure Act passed at the tail end of last year. It's now been a couple of weeks. We've had a greater opportunity to digest some of the fine print in there, and we want to share that with you. All of that and more, of course, on the program. Good morning, Central Florida. My name is Joel Garris. I'm with Nelson Financial Planning, and you're listening to Dollars and Cents, which is, in fact, Central Florida's longest-running radio program, and kudos to us. We were just named one of the top 25 financial planning podcasts on the web. So pretty cool to get that type of an accolade for the podcast version of this radio program. The top 25 list had shows from all over the world, Australia, Ireland, all over the U.S. We're the only one in Florida, made the top 25 list. That's really cool. If you're not a subscriber to our podcast, we encourage you to do that. Go to nelsonfinancialplanning.com. Upper right-hand corner, you'll see all of the different icons. Click on whatever icon looks most familiar to you and make sure you subscribe to it. Top 25 Financial Planning Podcast. That's pretty cool. We're very excited to that. And we thank the folks at FeedSpot for putting us on that list. Sort of came out of the blue. We didn't really even do anything for it. Didn't hear about it. And all of a sudden I got an email that said, hey, you made our top 25 based upon our panel of experts that decided it. So very cool. We're excited about that. And obviously that allows us to kind of kick the year off pretty well. That's for sure. Speaking of that, obviously our firm is in a bit of a growth mode. And so we are advertising for an additional front office position. And so we posted the ad on Facebook. We posted the ad on LinkedIn. And as I'm going through these resumes and calling all of these people, all these area codes are different. I'm like, where are these area codes? There's no 407, there's no 321. I'm like, where are these area codes coming from? So as I call these people to do a phone interview, we always like to ask just kind of what the background is and where they're from. And more often than not, what I've been hearing over the course of the past 2 weeks is they're all from out of state. They're not from Florida. They just came here from all different types of states, the majority of which is from the Northeast. And so we've been hearing this past week or two, where we've been hearing a lot of conversation about the census numbers and how much a lot of those states up north are losing people and the implications that has on the political level, right? Because House of Representatives up in Washington, D.C., that's based upon the number of people you have in your state. And that can adjust, that can fluctuate. So it's expected that places like New York are, in fact, going to lose some of their voice in Congress, whereby places like here in Florida are going to gain. And so that's been a topic of late in the headlines. And what was fascinating then, in light of that conversation about the headlines that occur from the census and the effect that has on the political side of things, lo and behold, on Friday, the folks at the Wall Street Journal put pen or pencil to paper and actually proceeded to figure out exactly what the tax savings is versus a New York, a Massachusetts, a Connecticut versus Florida. And folks, if you're not a fan of the increased traffic that exists in Central Florida, well, when you hear these numbers, you might as well get used to it because it doesn't look like it's slowing down. So the folks at BDO, which is a large accounting firm, proceeded to do the analysis, and the article was interviewing the person or the lead of the group that did the tax work that came up with these numbers. And the lead expert at BDO is quoted as saying, I didn't realize that these numbers would be that significant. And so they really are relatively significant. And so we want to share those with you this morning. So when you look at the difference of a couple making $500,000, now granted, that's a good amount of money. You're doing pretty well if you're making pulling in $500,000 as a married couple. But if you move here from New York and maintain that same $500,000, you will save no less than $31,000 on your tax bill. If you move here from Massachusetts, you will save approximately $25,000 on your tax return. Now, that's some serious money. I mean, when you start talking about 5 or 6% of your income, that is a huge difference in terms of how much you have to pay in taxes. And let's face it, if you pay that money in taxes, guess what? That's not money that you get to use. If you're making $500,000 and you pick up an extra $25,000 or $30,000 a year, I'm pretty sure that you can find a way to spend that money in a way that you would enjoy it much, much better than sending it off to the government. If you move here from Connecticut, the savings is about $29,000 based upon a married couple making $500,000. Isn't that fascinating? It's kind of interesting given the experience that we're having as we interview folks for our new position that we're adding to the team at Nelson Financial Planning. All these people coming from different area codes, and we're looking at all these different area codes, and we're asking folks where they're from, and we hear, oh, it's not from here, it's usually from the Northeast. And then lo and behold, on Friday, the folks at Wall Street Journal printed the article that quantified exactly what the numbers were, and even they were surprised at how big the tax savings is. So if you don't like traffic, I'm sorry, it's not going to slow down, because the reality is that for most people, particularly folks that are retired, if we assume that you do not have a mortgage, which is always a good thing to go into retirement without a mortgage, then your two biggest expenses are the obvious, number one, healthcare costs, but number two, right behind that, would generally be taxes. So if you're in Florida, that number two, taxes, really starts to slide down that list because you have such a big savings. Oh, and the other thing is it's going to hit a high of 84 today in Orlando, and in Boston, they're going to see 33. So there's that as well, given that it is, in fact, sunny Florida. But some interesting numbers and an interesting experience that we wanted to share with you on the program this week, because we are, as we talk to people and interview people, my goodness, the reality is nobody's from here. And by the way, if you've got some front office experience and like to join a fun team that helps to make a difference in people's lives, check out our advertisement on Facebook or on LinkedIn. We're certainly still looking at applicants on a regular basis, but hopefully making the decision relatively soon as to who to add to the team. If you're interested, feel free to reach out to us or email us. You can email me directly. That's Joel, Joel, at NelsonFinancialPlanning.com. Love to meet you and add you to the fun-filled team that we work with on a daily basis at the office. We're going to take a break. When we get back from the break, we're going to start to dig into some of the fine print of the Secure Act. And there's a lot of it because what happened at the end of last year was a bunch of different bills all got lumped together and passed all at one shot. So we've unpacked it, and we've got a bunch of things to share with you on the program in the next segment. So we'll do that when we return here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, News Radio, WFLA, Orlando.
What's your case worth? Dial pound 529 on your cell. Pound law, that's all.
Hey, boss, check this out.
Welcome to the program, Dollars and Cents, Central Florida's longest-running radio program, and as of just this past week, one of the top 25 financial planning podcasts on the internet. Very cool stuff. My name is Joel Garris of Nelson Financial Planning. This segment of the program, we're going to chat a little bit about some of the fine print that is in the Secure Act. The Secure Act passed at the end of the year, and so consequently now we've had the opportunity to really kind of start to dig into some of the finer tuned print of the Secure Act, and wanted to share some of that with you because, as you might well imagine, in the fine print of everything, there's a lot to talk about. And you know, sort of the general overall concept of the Secure Act, one of the biggest things is the shifting of the required minimum distribution age to age 72. Of course, for 80% of the population, that really doesn't make a difference because 80% of the population is already using their IRAs and things like that to generate out income in retirement. After all, if you're retired, you've got to be getting income from somewhere. 80% of the population is already taking that money out. So that move to age 72 doesn't really drive the needle all that much. But what does drive the needle is the elimination of the Stretch IRA. Now, obviously, we've mentioned that in talking about the changes that happen with the Secure Act, but there's one twist to that. Now, because the Stretch IRA has been eliminated, and what the Stretch IRA did is it allowed the beneficiary of a retirement account to spread out the distribution of the money from that account over the course of the rest of their lifetime. So it was a pretty powerful tax planning, estate planning approach that said you can leave the balance of the account to continue to grow on a tax-deferred basis for the rest of your life, so long as you take out a required distribution that you had to each and every year. That was the concept of the Stretch IRA. All of that, of course, is gone now because the Secure Act eliminated it, and in its place, they said that you must distribute out the money from a retirement account that you inherit over a 10-year period of time. Now, there are some exceptions to that rule, and we'll talk about the exceptions because we think that's important as well. But here's the thing about that new 10-year rule for inheriting a retirement account. There is no required minimum distribution on an annual basis. That's very different than the old rules that said if you inherit it, you've got to take money out each and every year. And if you don't, then it's subject to a 50% penalty and taxes of what you should have taken out. The new rules, courtesy of the Secure Act, say you only get 10 years, but now you don't have an annual required minimum distribution. So that really does present a planning opportunity if you inherit a retirement account, because you really would be able to sort of stagger when that money is coming out. So let's say you inherit it and you're 60 and you plan on still working another 5 years. Well, if you've got income already, then you would wind up just having to take more income and paying more in taxes on income that you might not necessarily need at that point. Meanwhile, you're planning to retire at 65. What you could do is you could wait. You could not take any money out of that inherited retirement account and let it continue to grow on a tax-deferred basis over the course of the next 5 years. And then if you're retiring at, say, 65, and you've worked those next 5 years, and then you would then start to take that money out over that next 5-year period of time. So there is some flexibility with these new rules that say, hey, it's got to be 10 years. There's actually some planning opportunities if you're close to retirement where you would push those distributions into the back half. But just understand this: if you go all 10 years and don't take any money out, which in theory you could, well, that just means that at that 10th year mark, then you'd have to take out the entire balance. So it really does add a little bit of a layer of complexity as to how you deal with an inherited account. Certainly much more complex than how it was before, which was just simply, hey, you get to spread it out over the rest of your life, and you get to just take a little bit out along the way as part of your required distribution. Now, there are some exceptions to the new stretch rules. The old stretch rules of that life expectancy distribution still apply to certain groups of people, namely spouses. That's the first group. Folks that are disabled or chronically ill. That's the second group. And then the third group is minor kids. And that group of minor kids is a little unique because once they reach the age of majority, then the 10-year window would start. So let's say you name a 10-year-old as a beneficiary on your retirement account. You pass away. They must take out regular annual lifetime distributions based upon their life expectancy under the old rules, under the old life expectancy tables. But then when they hit age majority, then they've got to take out the remaining balance over the course of the next 10 years. So a little different there. Another group of folks that are the exceptions are beneficiaries that you name that are within 10 years of age of yourself. So those are the new exception categories where the old stretch IRAs still very much apply. A little bit of caveat on those minor kids, though, because once they hit the age of majority, then they've got to take it out over the course of a 10-year period of time. So then they'd have to kind of be subject to that same accelerated time frame that everybody else is now subject to. Another note is about qualified charitable distributions. Qualified charitable distributions typically are things that are contributions that you make to charity that are come directly out of your retirement account as part of the required minimum distribution. Now you don't have technically a required minimum distribution to age 72, but the rules still allow you, if you've turned age 70 and a half, to do a qualified charitable distribution, even though you don't have a required minimum distribution. So that's kind of a little bit of an oddity where you've got a feature that's sort of related to being a required minimum distribution that still exists starting at the old age of 70 and a half all the way up to age 72. So there's kind of a little bit of a gap in there where you could still do a qualified charitable distribution even though you had not hit age 72. Now, that qualified charitable distribution is limited to $100,000, and you must make that distribution directly to your charity. So a little bit of a kind of a nuance to the qualified charitable distributions. The fact of the matter is that they still exist as an option, even though your required minimum distribution might not necessarily apply. So those are some of the items in the Secure Act that have to deal with the fine print. Those are some of the bigger ones. In terms of other concepts, there's certainly some other concepts out there, particularly involving tax rates that apply to your children, along with a host of other sort of tax credits and a new way to take money out of your retirement accounts if, in fact, you've been hit by a disaster. So we want to get into all of those. We'll do all of that. But for right now, we'll take a break. And we come back from the break, we'll continue the conversation about some of the fine print items of the Secure Act. I've finally had an opportunity to really start to dig into the details, and the devil is always there. So we'll talk about some of the other fine print changes in the Secure Act when we return here on the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA. Welcome back to the program, ladies and gentlemen. Talking a little bit in this segment about some of the fine print of the Secure Act, passed at the end of last year. A lot of details in it. one of which had to deal with the tax on children. And if you have children that have unearned income, you know that that's always a little convoluted as to how the taxes play out. In the past, what happened is that whatever their income was, they wound up having to pay tax on that based upon your highest marginal rate. So that was pretty expensive. For the past couple of years, that actually shifted to being taxed based upon trust rate. So depending upon where that income fell, you might very well have noticed a savings on that tax bill. However, based upon the Secure Act, it now reverts back to how it was. So that tax rate is now back to where it used to be. So if you're filing those kids' returns, they've got unearned income on them. That means that you're going to also have to file those returns in conjunction with your personal return, because the tax rate on that income is based upon your marginal bracket. So a bit of a change on that as well. And then similarly, one of the changes was about the medical expense deduction, shifting that threshold that you have to get above back from the 10% of adjusted gross income back to the 7.5% of adjusted gross income. Of course, these days you've got less than 10% of the population that's actually itemizing their deductions. It used to be that number was about a third. Now, after the latest round of tax changes from a couple of years ago that had those much higher standard deductions, then you've got much less people actually itemizing. So good news, bad news on that is, okay, fine, the threshold for being able to deduct medical expenses stayed a lower threshold, but it's still a pretty high threshold when you stop and think about 7.5% of your adjusted gross income. If your income is $80,000 odd, that's a threshold of like $6,000 that you have to get above. Otherwise, you're not going to be able to write off any of those medical expenses. So the reality is, though, that change probably doesn't really matter as much as it may have in the past. What we may actually see from one of the provisions in the Secure Act is a much greater incentive for small businesses to offer retirement plans to their employees. And so this is a exciting development, particularly if you work for a smaller company, is now there's a number of incentives and specifically tax credits to be able to ultimately establish a 401k. Currently, there's a $500 tax credit that would help to cover startup costs of establishing an employer-sponsored retirement plan that is eligible to be used by an employer over the course of a 3-year period of time, meaning every year for 3 years. The Secure Act changed that, actually kicked that up by quite a bit. The Secure Act now changes that tax credit to the greater of $500 or $250 per eligible employee or $5,000. So if you've got 10 eligible employees, you would get a tax credit of $2,500. If you've got 100 eligible employees, well, then your tax credit is going to be capped at $5,000. But obviously, $5,000 tax credit is a whole lot more than $500. So there's some changes on that front in the Secure Act that are specifically designed to encourage small businesses to offer retirement accounts to their employees, along with changing the eligibility threshold down, meaning that for part-time workers, their ability to participate is a little bit easier. Previously, there were certain thresholds of years and hours that were much higher than the new thresholds that exist. So now the new thresholds are you work for 1 year over 1,000 hours or 3 years over 500, you wind up being eligible to participate. So that's good that they've lowered the barriers that allow folks to participate, particularly part-time workers. So positive developments there, obviously incentivizing employers to establish retirement plans for their workers, which is certainly a good thing. Also gives an additional tax credit if the employer sets up that plan to have some type of an auto enrollment or auto increase as well. So a lot of tax credits. So if you're a small business thinking of ways to help improve the benefits that you offer for your employees, there's a much greater range of tax credits that you would get now under the Secure Act than you would have gotten before. So certainly something to check into on that. Of course, another big part of the Secure Act is it removed the age restriction associated for making contributions to your retirement accounts. So that's great. But remember, the caveat, the number one thing to ask before you make a contribution to a retirement account is you've got to ask yourself, did I have earned income? If you didn't have earned income, which is work income. So earned income is not interest income, dividend income, capital gains, rental income, pension, Social Security. That's not earned income or work income in the language of the IRS. So if you don't have that, then you can't make a contribution to a retirement account. You must have earned income. So just be aware that even though they've eliminated the age restriction, they haven't changed the ultimate requirement, which is you still have to have earned income before you can fund a retirement account. So just be aware of that. We've already had a number of questions about that in the office, and the reality is that that first threshold of you got to have earned income, that certainly has not changed. One other major shift in the fine print of the Secure Act is specifically addressed to folks that encounter weather disasters. And if you've ever encountered it, and certainly here in Florida, we've certainly seen our share of that, you wind up potentially having a very devastating effect. And so what the Secure Act does is it adds a qualified disaster distribution exception to the list of exceptions that exist for you to take money out of your retirement account. So you know the typical exceptions: if someone dies or is disabled, or first-time home purchase, those types of things, you are exceptions from the 10% penalty for taking money out of a retirement account. Well, they've added another one, and this one has to deal with qualified disaster distributions. You can take up to $100,000 for each disaster, and it's exempt from the 10% penalty. More interestingly, it's treated as though it is distributed over 3 years, which allows you to spread out the tax implications of that distribution. And it can also be repaid within a 3-year period of time. So a much longer period of time in which you could actually repay that money. And it also changed in light of that qualified disaster distribution. It also allows you to borrow up to $100,000 out of your 401k. The normal limit of $50,000 is doubled for a qualified disaster distribution, and also allows you to delay the repayment of that loan on a 401k for up to a year. So that qualified disaster distribution, very new, brought about as a result of the Secure Act, and certainly that's very valuable, particularly for us living here in Florida, who from time to time have to deal with hurricanes and floods and whatnot. And so that's a new option that you have to take money out of retirement accounts and not have to worry about a 10% penalty or anything like that if you are not of retirement age defined as 59 and a half. So that's a lot more of the fine print in the Secure Act. So some interesting stuff in terms of some tax credits for employers and new options to be able to take money out without a 10% penalty. And so certainly a lot in the fine print that we wanted to kind of share with you based upon our continued review of that legislation. So we'll slide to the break. You're still listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando. We get back from the break, we'll chat a little bit about the latest hot product in the insurance industry coming up next on the program. Welcome back to the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio WFLA, or you may be listening to us on our podcasts, which would be available 24 hours a day, 7 days a week. just named one of the top 25 financial planning podcasts on the internet. So be sure and check us out and subscribe to us. Have you been pitched on the latest hot product in the insurance business? It's a redo of what we saw from the 80s, and it's one of those things where we're back to the future, if you will, where they've brought forward the product that was known well in the 80s as a cash balance type of an insurance product, and now they have it as, back then it was known as a basic universal life insurance policy. Now it's been brought back and freshened up as an indexed universal life policy. And when we say it's a hot product, it's gone from just 4% of insurance sales 10 years ago to over a quarter of all insurance sales last year. So it's the latest hot product. It's indexed universal life. It's no different than what you saw with basic universal life back in the 80s. The difference is, or at least the hook is, that an indexed universal life is connected to the stock market. Well, guess what happens? If the stock market's going up, then this works just fine and dandy. But the reality is, when you get into a flat or a down market, that's when the trouble happens. Not unlike what happened with that basic universal stuff back in the 80s. Back in the 80s, when you had very high interest rates, people flocked into that basic universal life insurance. And so consequently, the interest rates that was getting credited to the account allowed the cash balance in those policies to grow at a pretty good clip. And that growth then allowed for the cash balance to stay ahead of the expense associated with the life insurance component of that policy. Well, what happened after the 80s? Interest rates fell. And when interest rates fell, the expense deductions continued. And here's the kicker on those types of insurance policies. The expenses, in fact, go up over time. So as you age, the cost of the insurance goes up. The expense that's hitting the cash value of that policy continues to go up. And you wind up, much like many times we see in the office, people in their 70s, 80s, and even 90s still trying to pay on these modest policies that they got back in the 80s, and that they don't want to give them up because they've put so much money into them over the course of the 30 years. But because interest rates aren't what they were back in the 80s, the expense of those policies, because the expense also keeps going up as people age, is literally chewing away at the cash value. And so consequently, those basic universal life policies are presenting no good options to the people that own them or that have owned them since the 80s. Well, it's the same thing with an indexed universal life policy. Right now, sales are going through the roof because, much like in the 80s when interest rates were high, of late the stock market has been doing well, and so consequently they've been getting a lot of attention. Marketed as a can't miss, no risk type of proposition, the reality is that there's a lot of fine print in those types of policies, particularly relating to how they actually credit the performance of the market. Remember, these indexed universal life policies are indexed to the stock market, and so consequently what they do is they allow you for some level of participation, and that's the hook, is they make people think that you're going to get all the upside of the market with none of the downside risk. The reality is, through caps, through participation rates, you never really get all of the market. What's a cap? Well, a cap is simply a cap of, say, 10%, which is the traditional cap that you see on these policies. What that means is, last year when the overall markets are up like 25%, you don't get 25, you get the cap, the max, which is only 10%. So you left a tremendous amount on the table. Who was the beneficiary of that extra amount that you left on the table? Oh, well, the insurance company, of course. That's how they do it. The other problem is the participation rate. So the participation rate may be, oh, well, you only get 30 or 40 or 50% of the overall performance of the market. One of the biggest ways that they play games with the numbers is they strip out the dividends of the market. If you do that, then automatically you're only going to get about half of what the performance of the market is over time. So be careful of these index universal life policies between the market caps, the participation rates, and of course, my favorite, on any of these policies, the insurer can change the deal at any point in time. Yes, they have to go through the state and get approval, but hey, you're dealing with something where they can unilaterally change the terms of the policy. And that these index universal life policies work very similar to kind of how basic universal life insurance work. You put the policies in, you put the premium in, the premium goes in, the expense of the insurance gets deducted, and the kicker is, oh, the market went up, so you'll wind up getting a piece of that kind of performance. And then what happens is everything is all fine and dandy so long as you have a decent market, much like as long as you had high interest rates on these same types of policies that were issued in the 80s. But then if things sort of go sideways for a little bit, or in particular as you age, the cost of the insurance goes up much more than what the market is going to, particularly as you start to get into your 70s and 80s. And so what happens is those fees over time that typically get larger and larger wind up getting more and more of that underlying balance to the point where the cash value, you eventually see it slipping away. And then, of course, when that happens, that means you've got to put a whole lot more money in than what you originally had to do, because now the premium is much, much higher. So, bottom line, unless you want to repeat your mistakes of the 80s, which I don't think you do, although it had good music, you don't want to repeat the same mistakes that you made in the 80s. You stay away from this type of product. It's the same product that was around in the 80s. The 80s product had high interest rates, which made it very appealing. The second that story changed, the mechanics and the math and the cost imploded dramatically. It's the same thing all over again. They've just rebranded it, correlated to the stock market, because the stock market has had a good performance period for the past few years. And so consequently, the sales of these products have jumped from just 4% up to 25% of all sales of life insurance. So be careful with it. Stay clear of it, because what's going to happen is over time, the cost is going to increase. And as you age, that cost is going to chew away at the underlying cash balance, particularly if you run into a period of time where the market is flat, or simply the participation rates and the cap rates prevent you from participating in the entire performance of the stock market in the first place. And so consequently, the cost keeps going up. You're going to look at that sometime in your 70s and be like, wait, what happened to my cash value? And why are they sending me a premium coupon that I have to pay in some exorbitant amount of money in comparison to what the premium was when I first got this policy? That's how all of this stuff works. It's back to the future once again, particularly with these policies. Stay clear of them. They didn't work in the 80s, and they're not going to work in the 2000s and 20s either. So stay clear of that. They've become an incredibly, incredibly popular product, and we encourage folks to stay clear of that. So that's the breakdown on the latest out of the insurance industry. Those guys are always good to generate out some products along the way, particularly in order to generate business. The latest on the Secure Act, certainly a lot of fine print in there, particularly, I think most importantly, the notion that, yes, the ability to stretch out a retirement account that you've inherited over the course of the rest of your lifetime is certainly gone. But the reality is that there's some real planning things that you have to work through, because there's no required distribution over the course of that 10-year period of time that you must take that money out. You could delay it all until the very last year to take out the total amount of that. Be careful, though. Obviously, that's going to jump up your taxes and certainly a tremendous amount of other fine print involving employee retirement plans, tax credits, and things like that in the Secure Act. So some fine print across the board on that. Remember, yes, they removed the age restriction to make contributions to your retirement accounts, but you still have to have earned income. It won't work, and you are not going to be able to make a retirement contribution unless you've got earned income. Earned income meaning work income, not retirement income, not pension income, not Social Security, not dividend. None of that is considered earned income that allows you to have a retirement plan or to make a contribution to a retirement plan. So make sure that you're aware of some of those changes involving the Secure Act. Certainly a lot of fine print on that. So that's the show. We'll wrap it up and get on out of here. Enjoy the rest of the day. And thanks for listening in to us here at Dollars and Cents. My name is Joel Garris of Nelson Financial Planning and News Radio, WFLA.